Well, Fed Chair Jerome Powell calling for flexibility in the central bank's forecast methods. This comes amid the debate between those who believe the Fed is engineering a soft economic landing. Meanwhile, during Yahoo Finance's Invest conference, DoubleLine Capital CEO Jeffrey Gundlach warned of recessionary signaling.
We have a lot of major indicators that have been in recessionary signaling for a year plus. And so I think the Fed has stopped raising interest rates. I don't think they're going to do it again. That's clearly the message from the bond market.
With economic uncertainty looming and traders betting the Fed is done raising interest rates, where does this leave the high yield market? Here to discuss is David Forgash, PIMCO head of leveraged credit. David, it's good to talk to you. Certainly an interesting time to be
Sure.
where you are. We have seen the yields pull back, at least on treasuries, over the last few sessions. I mean, how are you looking at where things are moving right now in the context of where the Fed is? We've talked a lot about how the market has been doing a lot of the work for the central bank.
Yeah, well, the market has, and we've seen some slowdown so far. But when you think about how high yield is positioned currently, which is in a pretty strong place compared to any other time of the Fed raising rates. So balance sheets are actually in pretty good shape. And most of the companies in high yield were able to term out quite a bit of their debt over the past year and a half when Fed rates were very low. So they've locked in some pretty good low coupons. So it's quite attractive.
And what about the underlying fundamentals, David, of the companies issuing high yield debt? How does that look to you right now?
So the fundamentals is really, you have to take each credit at a time and you have to look at different sectors. But the fundamentals themselves, the companies that we look at or that are involved in the high yield market. And by the way, when I say high yield market, it's really just one big credit market. It includes high yield, leverage loans, private direct lending. It's one market because it's all really fungible with each other. So when you look at the underlying fundamentals of them, they've held up. I mean, the expectations at the beginning of this year was that you would see EBITDA decline, earnings decline, and we really haven't seen that so far. A lot of it has been helped by the consumer, but you've seen these companies hold up very well, even with Fed rates hiking. Now, of course, it does raise the cost of borrowing, especially in the leveraged loan market where they're floating rate coupons. But in high yield, they actually were able to lock in, like I said, these rates, and the average coupon is quite low historically. It's 6%, even though you're getting about 9.5% yield all in on high yield.
And Dave, are there certain sectors that look more attractive to you right now? You know, is it energy or retailers or real estate?
Yeah, well, you think about energy in the past, and that was always the area where there was the most strife as far as defaults. They had levered balance sheets. That's actually not the case right now. There were some defaults that took place after COVID, but they've actually done quite well as far as taking down the risk in those balance sheets. In other words, paring down their debt. They're actually some of the best performing credits this year in the high yield market. And energies, we've seen a lot of them move up, which is what we call a rising star, so move from high yield into investment grade. So energy's in a pretty good spot. There are some other sectors that are concerning. Those are sectors that borrow quite a bit of money for CapEx. So you think about telecom, cable, those types of companies that borrow a lot and have locked in either high rates now or will need to continue to fund in higher rate environments in order to pursue that CapEx. That's where the issues are generally going to be centered as we enter this next year. And we're already seeing some of it right now.
So certainly a lot of investors looking to put some of their money to work on that front. You mentioned energy as one place. What are some other sectors where you're seeing attractive yields?
Yeah, well, let's just talk about yields in general then. So if we talked about where we were just when the Fed started raising rates, high yield was at 4%. This is a very un-high yield level. It's kind of like driving a car uphill at a very smooth road, but you just don't know. You're just not really getting anywhere. Currently, and if you wanted to get real rates or real returns, you'd have to go out to triple Cs, which are, as you know, the riskiest area in high yield. Now you can invest in a very resilient portfolio of high yield credits, double Bs, so just below investment grade, and have a 8.5% yield, 8.5% yield, which is very attractive if you think about it, because the long-term average for this, where defaults are very low for double Bs, it means that you will have some of the highest after default yields or the highest locked-in yields really since the great financial crisis. So it is a very attractive time to invest, generally speaking.
David Forgash from PIMCO. David, thank you so much for your time and insight today. Appreciate it.
Happy to be here.